Thank you very much, sir. And I would like to begin by thanking President Gill and the organisers of this conference for the invitation to be here. It's a great honour and great excitement for me. I've never been in Turkey before. I just want to say a small thing, that I think this question about whether or not we're in a post-crisis time is somewhat questionable. For me, the crisis continues, but it is, if you like, shrouded and obscured by quantitative easing, basically. But underneath the fundamentals, the structural problems are still there. So I want to just quickly, if I can, whip through some of the key issues that I believe are important to our discussion today about Islamic finance and sustainable finance. Frederick Soddy was a chemist, actually, and he said that debts are subject to the laws of maths, not to the laws of physics. Unlike wealth, which is subject to the laws of thermodynamics, debts do not rot with old age and are not consumed in the process of living. On the contrary, they can rise exponentially. And that's the problem with debt. Here is an example of growth patterns. We have A, which is the natural growth pattern. It's the way in which nature renews herself. Then there's a linear growth pattern, and then there is the exponential growth pattern. And the exponential is what happens to debt when it is compounded, when it's defaulted upon, and so on. So these two growth patterns are in direct contradiction with each other, and they cause major instability both in our ecosystem but also in our financial system. So the economic orthodoxy is that money is like a commodity. It's subject to market forces of supply and demand. Now, this is really, we knew back in 1694 in Britain, when the Bank of England was founded, that this was not the case. But it is still a myth that's perpetuated by mainstream economics. And there's also the assumption that the rate of interest on the full spectrum of lending is subject to market forces of supply and demand, that there's something called the natural rate of interest. I contest that very strongly. The rate of interest is not something that is determined by a demand for savings, as John Maynard Keynes taught us. The rate of interest is determined by the demand for assets. The fact is, right now, we see that there's a shortage of assets in the world, which is why easy money, starting with QE and so on, is flooding into certain assets, limited numbers of assets, property, stocks and shares, foreign exchange trading, that kind of thing, and blowing huge bubbles, mainly because that money hasn't got enough assets to invest in. Keynes was very interested in liquidity preference, in the preferences of investors for keeping their money liquid or illiquid, and wanted us to produce assets to match that liquidity preference. That does not happen. So the economic orthodoxy is deeply flawed. The fact is that credit, money, finance is a man-made construct. It's a social construct. It's not a natural, it's not a commodity. And the rate of interest is made by, for example, committees of men and women in the central banks, setting the base, just the base or the policy rate, or by the backroom fixers in banks like Barclays, which manipulated LIBOR. The Barclays scandal exposed the fact that the rate of interest is not something that is determined by supply and demand. It's something that's fixed by bankers, and so it should be. They fix it in relation to the degree of risk associated with a loan. So the orthodoxy is the assumption that banks use their reserves for lending. There's this myth of fractional reserve banking. In Britain, we've not had fractional reserve banking since 1694. It's a joke. And yet it's very pervasive, especially amongst monetarists. And that is why Paul Sheard, who's the chief global economist at Standard & Poor's, on the 13th of August this year, had to write a paper for all his clients in which he said, "Repeat after me, banks cannot and do not lend out reserves." There is a very flawed notion of the money multiplier. Reserves are what banks use for clearing amongst themselves. They don't use it for lending. Nevertheless, very senior figures in global finance, like Tim Geithner, who was for some years Treasury Secretary of the United States, would have us believe that credit does not exist, that stripped of its complexities, the purpose of a financial system is to let those who want to save, whether for holidays, retirement, or a rainy day, let them save, and those who want to borrow, whether to buy a house or build a business, to borrow. And it is to use our banks and other financial institutions to bring these things together and to manage the risks involved. That is a joke. That has not been the case in banking since 1694. And yet we have the Treasury Secretary of the United States talking about banks as intermediaries. They're not intermediate, they create credit. Because credit is not subject to supply and demand, because bankers are not intermediaries between savers and borrowers, the price of credit, or the rate of interest, is necessarily a social construct, man-made, and should always be low, for the reasons I hinted at the beginning. It's not a commodity, it's not subject to the laws of supply and demand. There need be no limit to its creation. There's a limit to the amount of gold in the world, to the amount of oil in the world, to the amount of silver, to the amount of land. There need never be any limit to the amount of credit that we can make available, because it is a social construct. And as Keynes said, if it is possible to create credit so easily, its price, the rate of interest, should always be low. So a low, reliable rate of interest, below the average rate of profit on investment, which over history has been 3%. Of course, there are years in which it goes up and down, but on average, for firms across the spectrum, 3% is what they expect to make every year. A rate of interest above that means that the repayment of that debt is unsustainable. It is unrepayable. So, just to prove the point about the creation of credit, I want to quote from Governor Bernanke. In 2009, in March 2009, he made available to AIG, which was not a bank, it was an insurance company that had an account with the Federal Reserve. It should never have had an account with the Federal Reserve. He made available to AIG $160 billion. And then he went on television. This is him on telly. And the journalist said to him, Governor Bernanke, where did you get this money from? Was this tax money? Says the journalist, because the journalist believed that he'd raised $160 billion from taxes. And he said, no, it's not tax money. The banks have accounts with the Fed. He ignored the fact the AIG is not a bank, much the same way that you have an account in a commercial bank. So to lend to a bank, we simply use the computer to mark up the size of the account that they have with the Fed, $160 billion. Personally, I'm very glad that he did that. He did that, he began the process of stabilizing the system. But let's not kid ourselves. That money was not earned, it wasn't income from investment, and it wasn't taxation. It was numbers entered into the keyboard of the Federal Reserve's computer. Because there is no limit to the availability of credit, employment and income should never be constrained by the availability of finance. When our leaders and our politicians tell us there is no money to create jobs, there is no money to tackle climate change, there is no money to transform our economy away from fossil fuels, there's no money to deal with HIV, with poverty, with Alzheimer's disease, we must remind ourselves that our system, our monetary system, ensures that there should never, ever be a shortage of finance. We need income, of course, to repay that credit, but that we can only earn through employment. And because there is no limit to the availability of finance, because it can be created by entering numbers into a keyboard, that is why it must be regulated, managed, and controlled. Because when it gets out of control, as it is now, it creates chaos, poverty, destruction, and misery around the world, and enormous wealth for a very small number of people. So, the banking system creates 95% of the money in Britain, and I'm pretty sure it does that in your country as well. It's not the central bank. The other myth that's peddled is the central bank is printing money. It's very striking. Monetarists never talk about private banks printing money, but private banks print money too. According to Mervyn King, they print 95% of the money in circulation. So in a monetary economy where both the central bank and private commercial banks create money by entering numbers into the computer, the relevant consideration is the availability of finance, not savings, and there need no be constraint on that. And the other consideration is, are there assets into which this can be invested? You know, is there employment that can be created? There are limits to the amount of labor. There's a limit to the amount of land. There's a limit to the amount of assets, but never to the amount of money. So we began in Britain the whole process of deregulation of the financial sector, egged on by economists who did not understand the nature of credit. And we introduced something called competition and credit control, which many economists describe as all competition and no control. And this is what happened, the elastic production of credit. This shows you the way in which credit grew from 1950, which is when the Keynesian constraints on the creation of credit were still in place, when there was still regulation, when it was still managed, to what happened after the revolution from 1971 onwards, pre-Thatcher, by the way, and pre-Reagan, when the United States created 300% of its GDP in household and other forms of debt. At the same time, we can see, I love this chart. This chart is from the Financial Times, and it shows interest rates from 1914 through to 2009. And you can see this period, sorry, I'm losing here. You can see this period between 1931 and 1950, when effectively Keynes was in charge of managing rates of interest in Britain, and they remained very low. And why was he put in charge? Because Britain was going to war, and it needed to have low rates of interest to be sustainable to finance a war. And you can see that using his methods and his management of the monetary system, he kept them low. But then the finance sector began to break loose, and we can see with Mrs. Thatcher the result of liberalisation. You get very high, very unsustainable rates of interest. And these, by the way, are only base rates. These rates bankrupted a lot of very healthy companies in Britain at that time. And here we see from Richard Koo some wonderful pictures. The myth perseveres that the cause of the financial crisis was low rates of interest. And I'm going to argue the cause of the cause of the crisis of 2007-9 was very high rates of interest. Of course, what we had after the dot-com bubble burst in 2000 was that Greenspan and co. brought interest rates very low down in order to save the banking system, in order to save Wall Street, basically. And then he kept it low for a while. But you can see from 2004 how absolutely systematically interest rates start to be raised. First in the United States, that's the red line. The green line is the European Union. Britain is already at very high rates of interest. Japan keeps them very low. Think of these high rates of interest as daggers aimed at a bubble of debt. And it's those daggers that burst the bubble of debt. Here we have a chart. Am I coming? I thought I was going to be too. So I have this chart. This is from Rogoff and Reinhardt. And interesting, Rogoff and Reinhardt are very fond of the orthodoxy. They defend the orthodoxy to the hilt. What this shows you is that the numbers, capital mobility and the incidence of banking crisis, the correlation between capital mobility and banking crises. And you can see that when capital mobility was constrained between 1945 and 1970, in the words of Barry Eichengreen, the famous historian of the financial system, there was not a single banking crisis anywhere in the world. So if we want to avoid crises, if we want to deal with banking crises, we have to deal with capital mobility. And I just want to end on this note, because my presentation went on to say that we cannot have low rates of interest without controls over capital flows. If a central bank wants to manage the rate of interest in Turkey for the interests of Turkish entrepreneurs, businessmen, farmers, and people, then the Turkish central bank has to manage the flows of capital in and out of Turkey. So we need capital controls in order to have low rates of interest. So if, as Islamic financiers, we want low or negative rates of interest, we have to look at capital, at the financial architecture which encourages capital flows. Thank you very much.